Thank you very much for your time today. And I wanted to start, before I get into the webinar, just to thank everyone for coming on out of giving up their time with their families. So thank you very much for doing that. What I'm going to cover today, there's a lot of content on there. I'm going to go pretty quickly though, because I'm going to be able to send a recording out of this, including the slides and me talking, so that you can watch it again at your leisure and go over the bits that you want to go over the bits that you want to double check for yourself a bit more detail on. But there's deliberately a lot of content on the slides too, because then you can read it too and take it in a bit more. But I'm just going to go through reasonably quickly because it's a heavy-ish topic, so I don't want to labour too many things. And I'm going to go through some examples. So one thing I did want to bring up before I get into the webinar is it's come to light via a client of ours about the super and paying the super quarterly, and how the ATO are really starting to attack people who aren't paying their super on time. So for those of you who don't know, the majority of you out there will be paying your super quarterly, and the super is due 28 days after the end of each quarter. Now, that 28 days, and this is why I want to reiterate it, is not you paying it, it's them receiving it. Because what you got to realize now with, the software out there and the way it's paid, it can take 2 or 3 days from the time you authorize and pay the super to it actually be received. Sometimes a couple of days, even more, depending on who the fund is and who you bank with and all that sort of stuff. So it's really crucial that you allow, quite a few days, because this client of ours, some of the super, well, this is before our time, unfortunately, before we were working with them, but some of the super was quite late, but others were just a day or two late, and they're making a big deal out of it and throwing the book at them for the ones that are 1 or 2 days late. So what I really wanted to highlight is please allow plenty of time to pay your super and get to the super funds that you're paying it to, because it's receipt of the money in the super fund that it's got to be by the 28th, okay? So please be very, very careful with that. Okay, so to answer any questions at all, guys, chuck it in the chat box and I'll come to it at periodic intervals. And the webinar and the slides, you'll get a full recording of this, which includes the slides and my commentary, okay? So that's no problems whatsoever. So let's start. Instant asset write-off. A lot of you guys are probably familiar with this, and some of this stuff, I assume no knowledge because it's safer. So what I'm going to be going through, some of you guys might know some of it. Bear with me because I know you won't know all of it. And it's the bits and pieces that you don't know that can make a big difference to you. So basically speaking, the instant asset write-off can be used for multiple assets as long as the cost is less than the appropriate threshold, and also new or second-hand assets. Now, I'm going to be going through in a few slides' time, I'm going to be going through a table to show you how much the government and the ATO have changed the asset write-offs over the years. It's unbelievable how much they've changed it. So I'm having tonight's webinar to not just discuss the rules now, but to go back 1 or 2 years in case people are behind in their tax returns and financials. At least they know the appropriate rules for that as well, because not everyone is up to date. Understand that. So multiple assets, and you can buy 10 assets. If each asset is less than the relevant threshold. There are some exceptions which I'm going to cover, and as I said, they can be new or second hand. Now, you can't do this with assets that are excluded under the simplified depreciation rules, which I'm going to cover in a minute. The most recent changes, which most of you probably are aware of, is for assets that were bought between the 12th of March 2020 and the 30th of June 2021, and then they extended it to 31st of December 20, the instant asset write-off threshold amounts is less than $150,000 per asset, which went up from 30,000, which is a big jump. And the eligibility changed to businesses with turnover of less than 500 million, up from 50 million. So it's a big jump. They're allowing a lot more businesses to take advantage. They were allowing a lot more businesses to take advantage of those rules. And then from 7:30 p.m., which is, for all those who don't know, that's budget night. Budget's normally May, but because of COVID, they extended the budget till October. So 7:30 p.m. on 6th of October until 30 June 22 is when they brought in these new rules called temporary full expensing, which allows a deduction for the business portion of new assets for businesses with turnover under 5 billion. And if your turnover is under 50 million, it also includes second-hand assets. And bear with me on this. I'm going quick, but there'll be some examples to go through this to hopefully make it a bit clearer. And if your turnover is under 10 million, you can also write off the balance of a small business pool at the end of each income year. So what I'm going to cover in a nutshell is the eligibility criteria, thresholds, relevant exclusions and limits, how to work out your deduction, and I'm going to go through an example of temporary full expensing. So the eligibility to write off your assets instantly depends on your turnover, the date you bought the asset. This is really important, this third bit, when it was first used or installed, ready for use. So it's not when you buy it, it's when it's used or installed, ready for use. So for example, if it was a bit of equipment, but the equipment, say you ordered it today, but it wasn't installed for 3 months, it's in 3 months' time. Or if it's a car, obviously it would be when you drive it away out of the dealership because you've started using it. And the cost of the asset must be less than the threshold, which we're going to cover in a minute. This is the table I was talking about. This is how, I'm not going to go through it all, but this is how much it's changed. If you just go from 1 January 14, which is, 7 years ago, through to now, look at all the changes in the thresholds and write off what you can write off and what your turnover and all that is. It's been pretty hard to keep up with, to be honest, but the most important ones are the top two. And you can see they apply to less than 10 million and less than 10 million. And on the right-hand side, for assets that you've started to hold or use from 7:30 p.m. on the 6th of October to 30 June 22, the instant asset write-off doesn't apply because you then apply or use the temporary full expensing measures, which I'm going to cover in a minute. Now, for those businesses more than 10 million but less than 500 million, there's the rules. I'm not going to dwell on that. Exclusions. Okay. Car. I'd love $1 for every time I talk to anyone about cars, because a car is probably one of the most often bought assets in businesses, sometimes for full business use like utes and other things, and others for, to be able to claim it through their business and enjoy a bit of a lifestyle benefit of driving a car and claiming it in the business. Where you do those sorts of things, logbooks, the second example, logbooks become really important. We've got webinars on maximising your logbook and those sorts of things. I've had lots of conversations with people who have come over for the first time as clients and been told previously, oh, no, car's not worth it, you won't be able to claim it. No, waste of time, won't be able to get anything out of it. I say to them, park all those thoughts, park what you've been told before. Let's have a chat about how you run your business, where you live, where your business is, why you drive your car, what purposes, etc., and then what I normally do is I let them watch the webinar, or I ask them to watch the webinar on logbooks, and then the second part of that is then I talk to them about how to actually complete a logbook practically. So in other words, I go through the the webinars on the basics of a logbook or the fundamentals of a logbook, which maximizes your business use. And then the one-on-one part is where I have a one-on-one chat with them about how to actually complete the logbook, to understand the parameters of logbooks and how to get the most out of preparing their logbook. So, cars. A car that you buy designed to carry a load of less than a ton or fewer than 9 passengers never will be allowed to be 100% business use or deemed 100% business use unless you have a logbook. Your logbook will be what determines what the business use percentage of your passenger car or car to carry less than a ton. And just for those of you who don't know, you do a logbook for 12 weeks, you do it once, and it lasts for 5 years. Even if you sell that car and buy another one, as long as your business use is substantially the same, you can still use the logbook. So yes, it's a bit of work, but it's worth it, given you can utilize that logbook for 5 years. Now, the car limits, it's 57,581 for the 2020 tax year and 59,136 for the 2021 tax year. So the instant asset write-off is limited to the business portion of the car, which is what I've already given an example of. So the car limit for 2020 was 57,581. So if an example, if you buy a passenger car or a car that's not designed to carry more than a ton, then, and you've only got a 75% business use logbook, then the maximum you can claim for that car is 75% of the cost limit, or 75% of the cost of the car. Because in this example, the car was, it's assumed the car was bought for more than 57,581. So in that example, you're only able to claim 75% of the cost limit. But if your car was bought for less than the cost limit, it'll be 75% of the exclusive GST value of the car. You cannot, and it's really important, you cannot claim the excess cost of the car above the cost limit. It basically sits in the balance sheet and until you sell the car, and you can only claim up to the cost limit. Okay? Example. So a company, Edward and Edna run a small business, and what they did is they bought a luxury car on the 27th of March 2020. So that was before the new rules came into play on budget night. So that's up to the 150,000. So they bought a luxury car for 80,000. So you might automatically think, okay, it's under 150, I can claim it. No, because it's a car designed to carry passengers, you can't claim up to 150. The cost limit is your maximum. So using that example, the cost of the car is limited to 57,581, like I said. And therefore, in that example, assuming 100% business use, they will be able to claim $57,581 as a tax deduction in full in the 2020 tax year. So this is where I want to reiterate. Even though it's a car, right, it's really important to understand it, because a lot of people do want to buy cars as part of their business use and part of their running their business. So if you're going to do that, it's really important that you know what you can claim and maximize the claim, because, hey, getting a $57,581 deduction is awesome, I think. Now, the second part of the example highlights the other part B side of usage of cars. They also bought a ute. Now, a ute is designed to carry more than a ton, and not a passenger car. So what happens with that is, even though they bought it for $65,000, which is above the cost limit, because it's not designed to carry passengers, the cost limit for the car doesn't apply. Therefore, because it's under $150,000, which is the write-off threshold at that point in time, they're able to claim the full $65,000 as a tax deduction. Another example, They buy a new car for $70,000 to transport goods. He receives the vehicle on the 3rd of June. So the date that's applicable is the 3rd of June, because that's when it's ready for use. Because it's got a payload capacity of more than a ton and it carries less than 9 passengers, it basically means that the cost limit doesn't apply again, which is awesome, and it's deemed to be 100% use. GST. Now, if you are registered for GST, then it's the ex-GST amounts that are relevant for everything. So I'll go through an example. If a business is registered for GST and buys a car for $60,000, including GST, the maximum GST credit that you can claim is not 1/11th of 60,000. It's actually 1/11th of the cost limit. So the cost limit is 57,581 for that year. So the maximum GST you can claim is 1/11th of 57,581, which is $5,234. Now that's assuming 100% business use, because if it was 90% business use, you can only claim 90% of 5,234 on your BAS. Now, assuming 100% business use, the cost of your car is deemed to be ex-GST, $60,000, take off 5,234, which is 54,766. As that is less than the cost limit, then you get a full deduction of 54,766 in that year. Now, for assets you start to hold from 6th of October 20 to 30 June 22, the instant asset write-off doesn't apply because you're now eligible for the temporary full expensing, which we're going to cover in a minute. So exceeding the threshold. Someone owns a small business with a turnover less than 10 mil. They buy a ute for 40,000. He estimates the use 40% for business. Well, a lot of the time you'd probably be able to get 100%, even though the cost is of the ute is $16,000. At the time, the asset write-off was $20,000. So it's not the business use percentage that affects the asset write-off, it's the cost of the asset. So in this example, even though the ute was bought for $40,000, at the time, the asset write-off was $20,000. Even though your business use percentage is under the 20,000, it's not the business use percentage that you apply for it's the actual cost of the asset before you factor business use percentage in. So because of that, the $16,000 had to go to the small business pool rather than a full write-off. Another example, less than 10 million turnover, buys a van for 22.5 in January 19 and delivered on the 30th of Jan. The instant asset write-off at that time is $25,000, and because the cost was under $25,000, they're able to write it off fully. If it had been delivered prior to that, they wouldn't have been able to write off the other $2.5 grand because the threshold was $20,000. So they would have been stuck with $20,000 write-off, and the 2.5 would have been unable to be claimed as a tax deduction. Right, now this is an example of, it's got a bit more in it. So for example, the turnover is $9 million and you choose to use the simplified depreciation rules because your turnover is under 10 million. You buy an asset for $200,000 on the 1st of July 2020, which is the same time it was installed and ready for use. Now, the problem with that is you can't claim it fully because the temporary expensing only came in on the 6th of October. So you're back to the under $150,000 test. Now, because it's over $150,000, you can't write off the asset in full. So what has to happen is it has to go to the small business pool. Now, for those of you who don't know what the small business pool is, if you can't write something off, it goes into the small business pool. And the first year you buy an asset, it's depreciated at 15%. Thereafter, so year 2 onwards, it's 30%. So in this example, they had an opening pool balance of $151,000. They would add the $200,000 to the cost of the new asset to the pool, and the depreciation is worked out at 30% on 151 and 15% on the 200. However, temporary expensing came in on the 6th of October 2020. So what happens with temporary expensing is anything that's sitting in the general pool at the end of 30 June 21 or 30 June 22 can be written off in full. So effectively, they'll be able to get, in this example, a full tax deduction of $351,000 at the end of 30 June 21, which is gold. Now, I've gone through that. Now, where you buy, as I said before, where you buy more than one asset, it's per asset this is done. So effectively, all the asset thresholds, 30,000, 150,000, that's per asset ex GST. Okay, per asset ex GST. So it means you can go buy multiples of assets, and per asset you get a tax deduction as long as it's under the threshold. So up until 6th of October 2020, which is budget night, pre that, it was either probably $30,000 or $150,000 per asset. There are some exceptions, which we're going to cover in a minute. But you can potentially go and buy multiple assets as long as each asset is under the threshold, and the business use, if it's not a car, and the business use is 100%, then effectively you get to claim multiple asset, multiple write-offs. Temporary full expensing. So this is what's really in place right now as we speak. I wanted to go through some of the prior slides so that people who are behind or weren't in the 21 tax year, they still know how it applies for tax returns before that period. So to be eligible for temporary full expensing, your turnover must be less than 5 billion, which is a lot, right? So it's going to cover everyone who's on this call. And you'll be able to claim a deduction under temporary full expensing for the 2021 tax year and a 2022, because these rules expire at 30 June 22. To be eligible to expensing, the asset must be, if it's new or second-hand, it can be new or second-hand as long as your turnover is less than 50 million. And it was first held after 7:30 p.m. Australian Eastern Daylight Saving Time on the 6th of October, and it was first used or installed ready for use for a taxable purpose, business purpose, after 7:30 p.m. on the 6th of October and before 30 June 22. So to be eligible to claim all this stuff, whatever you're buying, it has to be installed and used or ready for use between 6th of October 2020 and 30 June 22. Now, I mentioned about the exclusions. Eligible assets do not include buildings and other capital works for which you deduct amounts under Division 43. So let me explain what that means. For you guys out there who have got investment properties, this will probably make more sense to you. But buildings and capital works, or structural improvements as they're also known, they're such things. If you think about a building, that's the hardcore costs. So that's things like slab, frame, roof, plumbing, cupboards, insulation, etc., etc. All the stuff that's really hard wearing, that sort of stuff. And that includes, if you're fitting out an office or fitting out a rental property or something that's income producing, structural improvements, certain amounts of structural improvements are also excluded under these rules. And the assets that also are excluded that will never be located in Australia or are not used principally in Australia or for the principal purpose of carrying on a business. So I want to stop there for a second. I've gone through some scenarios with some clients since these rules came in play. And what those guys were doing was fitting out. They're like, running their business, and they've bought premises, and they're setting up a new business, or they're buying a business in a new location, or moving their business to a new location, or whatever the case may be. But they're effectively the landlord and the tenant. So the tenant is the business, so that the tenant pays rent to the landlord. The landlord is also themselves. Obviously, you're going to run your business in one structure, and you're going to have your property owned in another structure. That's common sense from a asset protection and tax minimisation and tax efficiency point of view. But what I've done with them is I've worked closely with them and their builders or renovators to try and maximise these rules. So I've put together a table of information that they can use to work with their builder and us to try and maximise the stuff that's not Division 43. And if it's not Division 43 and it's a business that's fitting it out, so it's not the landlord, so the business is paying for the fit out, which is pretty normal, then they're able to maximise their full 100% write-off of things that aren't Division 43. And it makes a big difference to the end result of being able to maximise what you're doing in that space. Now, if your business turns over more than 50 million, you're also excluded from claiming a second-hand asset. Now, I don't think there's going to be too many people turning over more than 50 million, so majority of us are going to be fine, and it makes a big difference. Now, as I said, you claim a deduction for the cost when you start having installed or ready for use, and there's no general limit on the cost of assets which you can apply the temporary expensing for. So what I mean by that is, and I think I'll cover that. So what it means is, if you need some equipment or something that's not a car, basically, and you tick the boxes on the other, and it's not a Division 43 structural improvement or capital works expenditure, basically, you can claim 100% as a tax deduction on the GST exclusive cost of that asset, as long as it's installed and ready for use between the 6th of October 20 at 7:30 p.m. and 30 June 22. Now, the exceptions, as I've covered before, was the Division 43, which is capital works, and effectively passenger cars. Because remember, if it's a truck, or if it's a car that's designed to carry more than a ton and fewer than 9 passengers, and not be a passenger car, then the car threshold's not appropriate. So you can effectively write off a truck and a non-passenger car, or a car that's designed to carry more than a ton. You can fully write those things off as well. So I think there's an amazing opportunity between now and 30 June 22, if you plan to get some incredible once in a blue moon tax deductions that I've never ever seen in the whole time I've been running our accounting practice. And I don't think, touch wood, we never get COVID, or never get the extent that we've had COVID again, or something equivalent. I hope not in any of our lifetimes again. So this opportunity is a one-off, is how I see this. So with careful planning, you can really maximize the benefits for things like equipment and cars. Even, to be honest, even a passenger car, as long as you get advised on how to complete a logbook to meet the ATO criteria and to maximize business usage with the way you use your car, which, as I said, we work one-on-one with our clients to make sure they fully understand how to maximize logbooks, because there is, I've already covered, there's a misnomer out there that it's not worth getting a car. I don't agree with that at all. It's a matter of understanding the rules, having them explained to you, and then practically understand the application of what that means for you, and then preparing your logbook in accordance with the guidelines set out by the ATO, and understanding how to do it properly to maximize your business usage. So and you can finance those things too. So, for instance, you can finance the car, you can finance the equipment. So you might end up getting this wonderful situation where you finance something and you pay for it over several years, but you get a tax deduction immediately now. Now, in some situations, this might lead to a tax loss this year or maybe next year. Now, that's okay because tax losses carry forward to the year after. So you've got to think about all of this. But for instance, I work with people every day on this sort of stuff, and it makes a big difference to plan. So, for instance, if you know you're going to be doing something, definitely between now and 30 June 22, you need some new equipment, or you're going to be setting up some new premises and fitting it out, or you need a car or cars, some utes, some passenger, whatever. With some careful planning and timing, you can really maximize the tax benefits that are never going to be there again. Now, also think about it. If you're now, say, fast forward, 6 or 12 months, and we're now in the 30 June 22 tax year. So you know that your asset needs to be installed and ready for use or used before 30 June 22 to be able to maximize these deductions. Let's say you were planning on doing something sometime during the 2023 tax year. It might be wise, and this is where professional advice comes in, it might be wise to bring that forward and plan for it, for cash flow and financing and all the rest of it, where you can, because the tax benefit you get from careful planning makes a massive difference. Okay. Now, I've just got a question. If anyone wants to ask any questions, I'm nearly done. I told you I was going to fly through it. I just wanted to really reiterate that this is an amazing opportunity if you give some careful thought and planning to really get some wonderful results tax-wise for something that you would probably do anyway. And possibly, as I said, in the 30 June 22 year, to bring forward stuff that might be in the next tax year just to get the tax benefits, as long as you plan for the cash flow and implications of it. Now, they've said, just to clarify, as you've been saying 30 June 22 throughout the webinar, can you confirm if the current asset rules? Okay. The temporary expensing rules, which is what we're currently in, which means from 6th of October 2020 at 7:30 p.m. Eastern Daylight Saving Time, from that day till 30 June 2022, if you buy an asset and it is installed and ready for use or actually used between that day and 30 June 22, you can claim unlimited deduction, ex-GST, subject to the two main exclusions I covered, which is on passenger vehicles, where you've got the depreciation cost limit. But as I said, it's still powerful. If you've got a 90% business use logbook and you can go and buy an $80,000 car, right? You're still going to get a tax deduction of 90% of $59,000 odd dollars in one hit. Still an amazing tax deduction if you're going to go buy a car anyway, just with some education on how to do a logbook, or and obviously not including structural improvements or capital works. But there's lots of grey in the capital works, and this is where it comes down with working with someone who understands it, and then them working with your builder and or person that's fitting it out to maximise the rules, because it has to be the business owner that pays and fits out these things to get that. If it's the landlord doing it, these rules don't apply to landlords. They only apply to businesses. So it depends on your situation. It's not a one shoe fits all. But I still think, there's about 15 months left of an amazing opportunity to utilize the rules to get some great tax benefits. That will be an awesome tax planning mechanism with some careful thought and design and some good advice. So that's it for me. If anyone wants to reach out to us at all, customer care at superioraccountinggroup.com or our website, www.superioraccountinggroup.com. There's lots of free stuff on there, lots of webinars you can watch, you can download stuff off there, and there's lots of webinars. There's a logbook one on there, and there's travel diaries on there, and There's a whole host of webinars on there that you can have a look at your leisure that you will find valuable for you with your day-to-day running of your business. Otherwise, feel free to reach out. Did anyone have any questions? I will pause for a second. And look, I'd also say to you guys, if you know other people in business, please feel free to share this video with them, because we're in the business of helping businesses as well. So if you can share this with anyone you know who's in business, feel free to do so, because at the end of the day, we're all in this to make a dollar, as in, make profit. And we're all in this to also pay as little tax as possible with some careful advice and planning. So I'm more than happy for that to happen. Any other questions? No? I'll pause for a little bit. All right. No? All right. Well, thank you guys for giving me your time this evening, and taking up your valuable family time. I know it was pretty heavy and at times a little boring. I understand that, but there's a lot of good stuff in there that's worth it for you guys, for your businesses, and to make some good decisions. So until we speak again, take care and look after yourselves. Bye for all.